Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, National Underwriter for Old Capital, Paul Peebles. And joining me today is James Eng, also with Old Capital. Hey, James.
Good morning, Paul.
So in the podcast today, we're going to talk a little bit about insurance. And it's a very timely conversation to have about insurance on apartments and commercial buildings. And why is it so timely, James?
Anytime you have an insurance issue, it can come up when you least expect it. And so here in North Texas, we've had hail, we've had fires, we've had almost anything you can think of in the last couple of months. So we wanted to bring in somebody this morning to talk about insurance and how you go about finding the best coverage for your next acquisition.
So James is absolutely correct, is that we've had huge amounts of big hail coming from the sky. There was a property that we closed probably about 3 years ago. I talked to the owner. He was in a terrible panic last week, and that out of a 70-unit building, he had 35 tenants that had to be displaced because the hail not only penetrated the roof, but also went through the ceiling. That's how big of hail came through. So Kim is with us today, and she is with Heritage Insurance here in the North Texas area. I thought we'd kind of talk a little bit about insurance today. And so, James, I'm going to kick it over to you.
Sure, Kim. When people ask you what you do, how do you answer that?
We like to say that we provide insurance and miracles.
Miracles.
Yeah, miracles. Demystifying insurance is part of our mission statement.
Okay.
Because insurance is one of those nasty four-letter words, even though there's more than 4 letters in it. And so we try to make it not such a scary bad thing, because it really is there to help you if you know how to work it the right way. So we try to help people do that.
Okay. And how long have you been doing that, and how did you get into the insurance industry?
My husband and I have been doing it a little over a decade. Insurance is something that was originally my husband's passion, but is now quickly becoming my passion. I've always been into sales, so, sell just about anything, but selling something that you care about is really important to me anywhere that I've worked. But Sean's story is really interesting. He's a Hurricane Katrina refugee, and he owned a restaurant and a rental property close to the beach. Used to be 8 houses off the beach, now 3 houses off the beach. Right. The restaurant is just a slab because it was on the beach. Wow. And he wasn't covered properly from an insurance perspective, not knowing about it. And so that kind of started his search. And then he was picked up by a large conglomerate auditing and purchasing insurance agencies. And then that kind of started his education for that. And so that brings him to where he is now and where we are now, owning an independent agency. And it gives a little different perspective to how we look at risk, because we've been on the owner's side and we've been through a disastrous claim. So,
okay, maybe give us an overview of what that means as an independent agency, how you guys sort of interact with investors and how you work with them, and then what you guys do on once someone calls you and says, I need insurance on a 100-unit property. What happens on your side of the table?
So we're brokers.
Okay.
We aren't captive agents. Captive agents are those who work for a specific company and can only sell that company's products. Okay. For instance, farmers. Farmers, great company, only sells farmers' products. If you don't fit in the box, you have to go somewhere else. Okay. So brokers go to the entire marketplace, wherever they have access. Not all brokers have the same access. It's all about relationships, just like anything else is, and feeding the beast, feeding the carriers to keep the relationships good. And so as independent brokers, we have the opportunity to approach an entire marketplace to find what's best for our clients and that particular situation that they have.
Okay. And then, so what questions are you asking people looking at apartments? What questions are you asking them to get an idea of what markets to go and take that insurance to?
So we like to fill out what's called a statement of values. And a statement of values takes you through not only everything that's on an offering memorandum for a property, which I love to get. If you're looking at a property, send me the offering memorandum. That'll help give me a little bit of a picture for when I'm doing the rest of my research. But what you look at is not only where is this property? Are we talking on the coast? Are we next to a big river in Central Texas where I know it's going to flood? Are we in North Texas where I know it's going to hail? Where is the property? What is it made out of? Which seems silly, but different carriers like different things. How old is it? But then when has it been updated? Because those updates can put you in different markets. So you're always playing the game of how much am I going to spend on insurance versus how much coverage am I going to get? And that's the kind of game that we need to look at and be very decisive with from a chess perspective with insurance.
And when you say different markets, what you're really saying is different carriers. Mm-hmm. So it's not just different physical markets in North Texas or Central Texas. It's really what carriers that like that type of stuff, where one carrier will like this, another carrier will like that, and they may not be the same.
Yeah. So carrier appetite is really interesting, and they can get their appetite full. They can have a full appetite for a certain area for the year, and that may change next year. And so depending on when you're acquiring your property or when you're in your renewal will depend on what carriers have certain appetites. Just because the carrier you were with last year had an appetite for that risk in that location doesn't mean that you're going to hit in the sweet spot of that appetite this year, and you may have to go shopping elsewhere. And then just in general, appetites change. Same with personal lines. One year you get a really good rate on your house, and then the next year you don't. Same company, you don't understand why. In the background, all the underwriting with the actuarial people sitting in little rooms, they're the ones deciding the appetite. And that goes season to season, year to year, based on the events that we have in the marketplace.
Okay. Mm-hmm. And then when we're looking at coverages for multifamily, maybe explain what you recommend and what you see. Obviously, you see a lot of policies and you see what people currently have and then what you would recommend. So maybe address some of those gaps too. So sort of the basic coverage and then some of the stuff that you're seeing that multifamily owners aren't implementing in their coverages.
I think two things that are really difficult for people when they're attempting to purchase an apartment complex is they like to look at the current insurance. They look at that line item. All they see is a price, and that's not really a picture for them. It's also really important to note that sellers, to make their property look more attractive, of course, can reduce their insurance coverages, which of course is going to reduce their insurance premium. Okay. So without getting an actual copy of the policy, I think it leads a lot of dismay and a lot of confusion to the new or prospective buyers of a location as to what to expect. And so, of course, during due diligence, get a copy of the policy. You need it. Make it one of the first things you request because you want to see what you're really looking at. You can have as much or as little insurance as you want. I hate saying it's a game, but it's kind of a game. It's all about your risk tolerance as an investor. And that goes with anything you invest in, stocks, bonds, mutual funds, and properties. Risk tolerance is huge. So you have to have property coverage. You really need general liability coverage. If you're getting a loan, your lender is going to have certain requirements, and those can range from where your deductibles are structured to how much wind and hail you have. Do you have flood? Do you not need flood? Do you need terrorism? Do you not need terrorism? What are the limits of your property coverages and the limits of your GL? Do you need an excess general liability umbrella policy or not? So what I think is important coverage may be very different from what you or your lender thinks is important coverage.
A lot of times we'll place loans with the agencies such as Fannie or Freddie or maybe a CMBS or even a bank lender. What are some of the differences between those when they go out in their requirements? When you receive lender requirements, are you seeing a big difference between just your local and regional banks versus maybe an agency? Compare those to the two lenders and figure out what the difference between those are, if you could explain that.
I think one of the most stringent insurance requirement lists that we ever see is from DUS loans. Right. DUS, DUS, and that's a Fannie product.
Fannie, yeah.
And so those DUS lenders, they have a lot of requirements.
Yeah. Yeah, they do have a lot of requirements because the money that they're using is taxpayer money, and they want to make sure that taxpayers get reimbursed in case we have a fire on a property or a hail claim. So you're going to have more stringent probably coverage with a Fannie Mae or a Freddie Mac transaction than a regional bank. Not to say that regional banks don't have heavy coverage, but Fannie and Freddie are going to have probably the most coverage, and so will CMBS lenders too. Are going to have a tremendous amount of coverage requirements too. But as we say, it's good to have the coverage, just because there are some things that if you've done this as long as I have, 31 plus years, you're going to have fires, you're going to have hail claims, you're going to have slip and falls on these properties. That this is a business operated as a business. Take the risk as being very prudent to have the insurance and try to find out where the middle is. I mean, Fannie's going to give you minimum coverage pieces, but just like what Kim is saying is that you may want to find yourself in a position, if you need it, to get greater coverage on these properties.
So the DUS loans, some interesting things, because they're the ones that I see that really request the most coverage.
Right.
And the things I see there are not only do they want the property insured to the full value, meaning no coinsurance.
Okay.
Coinsurance, I always describe to people in presentations, as like the worst kind of deductible that you can have. And that's really interesting because a lot of carriers like to offer coinsurance because they want to make sure you're really insured to value, in a way that DUS kind of forces you to protect yourself from yourself in that instance is by not letting you have coinsurance on your policy.
And what is coinsurance?
So coinsurance is a penalty that gets placed on your policy if you have a claim and you're not insured to value. So kind of the formula is what you did insure your property for over what you should have insured your property for times the loss amount. And you'll see coinsurance as an 80%, a 90% penalty. And so people like to play, again, the chess game, the delicate game of, am I insuring this property to value or not? Just because the purchase price is at one level doesn't mean that that's the insured value amount, because what we look at from insurance is replacement cost. If you have massive hail or massive flood or a fire or a meth lab explode, which is always tragic, in an apartment complex, we have to replace that building at today's current construction prices and current construction labor costs. And so those change. They fluctuate throughout the year. Typically, depending on where you are, it's going to cost $115, $120 a square foot to rebuild property. But people like to insure their property for about $70 or $75 a foot, which means you're technically underinsured to value. And so when you deal with a lender that doesn't want coinsurance, that means the insured has to take it to that 110, 115 value. You can't play the coinsurance penalty of doing the math to figure out I'm at least 80% insured to value so I don't get the penalty, or 90% insured to value so I can lower my premium by lowering my per square foot value of the property, if that makes sense. So DUS forces you to kind of protect yourself in that respect to really being insured in value. But of course, that's going to cost more on your premium.
Okay. So how are you figuring out that replacement cost? Are you going off the engineering report, the appraisal? How are you guys, or do you guys do your own calculation on the replacement cost?
There's a lot of raters out there. I mean, being really plugged into builders associations, we work with a lot of builders. We've been on the Home Builders Association for Dallas for a really long time. So construction prices fluctuate, as I said, year to year, season to season. Right now, price of concrete and steel is high. You need that to build an apartment complex. Right. So when you're looking at, today's value, depending on the finishes, A, B, or C class property, you're looking at about 100, 110 a foot at a bare minimum to rebuild. And that's not just the material, that's the labor. But that's what the insurance company has to cut the check for, is the total rebuild. And so, if you're dealing with insured fully to value with no coinsurance, you're probably looking at 115 a foot. Okay. And so your lender has a lot a lot to do with that from a premium standpoint. And that price can blow some people away.
So they might have been at 60 a foot or 70 a foot. They might be buying the property for that amount.
That's what I'm saying.
And then you're saying your coverage might have to go up to 110 a foot.
So when I say get a copy of the policy,
right.
What I mean is when you look at the current policy, you'll see where the lender is, and you can kind of get an idea for what their requirements were. And you can definitely, with some short math, take the square footage of the property, divide it into how much insured value they have on the property, and figure out at what square footage they are to see where they are versus where you're going to have to be.
Okay, so do they need, let's say the seller's being difficult and they don't want to give you their policy, then when you come in on an acquisition, what other pieces of information does a buyer need to give you to get an accurate quote on a policy?
So, like I said, the offering memorandum is great.
Okay.
We have to fill out accord forms and statements of values and habitational supplementals because we have to paint a really nice picture for these different carriers where we shop it. So I need to know everything about the property.
And really what that means is that they want to see historically what kind of claims have been against that property for the last, say, 5 years.
Well, that's the loss runs.
You also want to get a loss run.
You have to get the loss runs. Those are...
Can you run those?
No, absolutely not.
So it has to come from the current
They have
owner.
to come from the current owner and the current insurance provider. And if they've switched insurance in the last 5 years, which people do, you've got to go to every individual insurance company and get those loss runs. Now, the current insured, of course, has access to those. And they should take like 3 minutes to get from your insurance carrier unless they're being difficult for some reason. But they have to be what is called currently valued in the last 90 days on hard copy letterhead in order for insurance carriers to accept them. So they can't be loss runs that they had from 6 months ago. They have to be loss runs in the last 90 days, and they have to be on that insurance carrier's letterhead. Mm-hmm. And we have to have a 5-year picture of those. So get those during due diligence. Updates to the property are huge. If you don't figure out when your plumbing, HVAC, electrical, and roof have been updated in the last 15 to 20 years during the sales process, the likelihood you're going to get that information from the seller later is almost nil. That changes your insurance premium, and it also changes what carriers you get to access. So that's really important information. And a partial update is still an update.
Okay.
That's important to remember. It's not like you have to have a full redo of everything, although that's nice. A partial update is also good.
So when the owners are getting under contract, getting an inspector out there early, the first week of due diligence, and figuring out what actually the age of these components of the property are, will help you in the insurance process.
They do.
So if someone sends you an inspection report and it has the age of every HVAC or chiller, boiler, those types of things.
Well, the inspection report helps, but inspectors can't age identify if it's not written down somewhere when something has been done. So really, your current property owner, if they've had any of that work done, should have receipts.
Right.
So they should be able to tell you exactly when that happens. And as the new owner, make sure you keep a hold of those receipts because you're going to be helping when you eventually decide to sell the property. If you decide to sell the property, you're going to be helping the next purchaser when they're doing their insurance due diligence by knowing exactly when you've had work to those 4 major systems happen. So more than inspection, those guys really can't age things properly. The inspection report is great. It does give a lot of information to the insurance agent, but it's not the whole picture.
So get as much information as you can from the current owner in terms of updates, and that will help save you on your premium. Okay, gotcha. Any other factors here in Texas that owners should be aware of? Anything unique about Texas when you go out and go to these different insurance markets that people like or dislike about Texas, and anything like that you can share that's unique about Texas?
I mean, Texas is a great place. It's a big place. There's a lot of different stuff happening in Texas, depending on where you're purchasing your risk. Flood is a big deal, not just because you're on the coast. Flood is a big deal in Central Texas. Flood can be a big deal here in North Texas. The type of dirt in the 3 or 4 different areas of dirt that we have here in North Texas can be highly clay-based, which doesn't absorb water quickly. And so we get flash flooding a lot. People forget that surface water is flood. Flood is not just a river overflowing or ingress water from a hurricane. Flash flood water is flood. That's how it's written up here. So any kind of surface water runoff is going to be a flood claim. And flood insurance is not always required here in the state. And a lot of people get burned by not having that kind of coverage. And so flood is not super expensive, but repairing flood damage is super expensive. So whether you're in a 100-year floodplain or not, you could be down the street from another building or location that is graded unfavorably for your property because of where they're water shedding their runoff. And that could cause you a flood issue. I mean, you're not going to be able to go to the people 3 doors down and ask them to pay for your flood
use
damage.
Their insurance,
no,
right? It's not going to work that way.
No,
huh?
you can't do that. You have to protect yourself. And so you may not be through a wet season or a rainy season when you're purchasing your property to know if you've got kind of water pooling issues. Now, when you're in your inspection report, a good inspector should tell you how your parking lot is graded.
Okay.
That's where we see a lot of flood claims is poor grading in the parking lot or poor settling of the parking lot over time, especially if you're dealing with B and C class properties. And a good inspector should be able to tell you where that grading issue is and if you're going to have a potential runoff issue that you would want to have addressed or at least purchase flood insurance for if there's a problem. That's one of the claims I'm dealing with right now.
Okay. Maybe walk into a couple of the deals that you have either helped people with acquisitions this year. Maybe give a couple examples of the coverages you recommended for that property and why, and maybe some of the unique situations that you've seen so far this year.
So 6 months ago, we were going through the purchase of a small apartment complex in Denton, and we got some great insurance. We were with a great carrier, but of course the wind hail deductible was high because here in North Texas we see a lot of wind hail. So you get a lot of that 2%, but of course you can do a deductible buy down, which if the deductibles for wind hail are excessive, per your property value, right, because it's a percentage, it's not a flat number. A deductible buy down is a great thing. It's something you definitely want to consider because we are going to have wind and hail events, and you're probably going to have to pay that deductible out to have a replacement. And so I like our clients to always look at a quote for deductible buy down. And if you don't purchase it at the time of the purchase of the complex, that's cool. You can buy it later, but it's definitely a cheaper way to deal with a big claim.
Explain how that works. I'm not too familiar with that.
A deductible buy down?
Right.
So let's say, just for round numbers, your wind hail deductible on a property is $10,000.
Okay.
And that's a lot. You need a new roof, and let's say the roof is going to cost $40,000.
Right.
Well, $10,000 out of pocket. Maybe you only own the place, like in this particular instance where we're having a claim, for 30 days when you have a wind hail event.
Right.
You haven't made hardly any money on the property yet. You're still in the refurbishing process, and now you got to come out of pocket $10,000 to fix this issue.
Okay.
That can be real strain for a lot of individuals and investors. So the deductible buy down works, and maybe I should just explain a claim in general for people. Let's say we have a hail event and you have a $10,000 deductible. Initially, the adjuster comes in and they do an initial report, and they always rate things at actual cash value. There's 2 ways to have insurance: replacement cost, which is of course what you want, and to get that you need updates on property. That's
everything we talked about.
Everything
right?
we talked about. I mean, that's the good information that gets you from an actual cash value policy, which is, the current price minus depreciation, up to a full replacement cost, which is what you want if you can get it for that particular risk. So let's say the adjuster comes in and says, oh yeah, this is, a $30,000 actual cash value claim, but maybe a $45,000 replacement cost claim.
Okay.
They're initially going to write you a check for the actual cash value amount less the deductible, even if you have a replacement cost policy. That throws a lot of insureds for a loop because they say, oh, I've got a replacement cost policy. They won't cut you a check for replacement cost until you've actually replaced it.
Okay.
So up front to get you started with your general contractors, they give you the actual cash value less your deductible, which sometimes can be zero.
Okay.
Because if your deductible is 10 grand and your actual cash value claim is 13 grand, then you take out your deductible. Well, there's no money. So then you have no money to start repairing your claim, which is a problem for people. In that instance, if you have a deductible buy down where we took our 10 grand down to something more palatable, like 2,500,
Okay.
they come in and they give you that first layer of here's your actual cash value minus your deductible. They might give you a little bit of money, and then you submit the claim again to the deductible buy down, which is a separate process. It's a separate claim because a deductible buy down policy is a separate policy altogether. So it works in a claim on replacement cost with a deductible buy down. There's 3 stages of your insurance claim. You get the first one, which is actual cash value. Then you make a deductible buy down claim and get your money there. And then when the project is finished, a secondary inspector comes out and reevaluates it and then cuts you a check for the remainder.
Okay.
And so it's important to realize with how much money you're keeping in your kitty for repairs, the steps that an insurance claim goes through, that kind of life cycle before you get made whole again, which is usually not till after you do all the work.
And then that buy down is just an increase in premium?
Yeah. And so it's a separate policy. You buy a separate policy for it. So it's not necessarily an increase in premium on your regular policy. You're purchasing another policy.
Separate policy.
Just like you'd be purchasing a flood policy or purchasing an excess general liability umbrella policy. Those are additional policies with their own premiums.
Okay. Is there anything when multifamily owners are going out looking at properties, anything that they should be aware of that would increase their insurance significantly over where it is? Anything else when they're walking a property? Anything in terms of those major systems? Anything that you've seen here in Texas that's a little bit more specific on walking a property? Anything else on that?
I mean, look around where it is. If you're close to a river and you're in Central Texas or North Texas, depending on the size of the river,
Right.
that is definitely something I would look at.
Okay. So flood zone.
Well, yeah, that could be a flood zone, but it may not. That may be a drainage river, a river specifically put there for runoff. And if the weather is bad and that river overflows, that little runoff creek, if you will, sometimes, how far away is that from part of your property?
Okay.
You know, look at signs for regular water damage from large rainstorms, where the downspouts go, what direction are they pointing? You know, that can ingress water into a certain unit.
Okay.
You know, so you'll want to look at things like that, and that looks like mold on the outside of the bricks, a lot of dampness in an area. Standing water is always a problem. You know, if you're close to the coast, how close to the coast are you? Are you within 100 feet of the coast or not? Like if we're down on the coastal areas, look at how many big trees are around you. Because if we have high winds and a tree snaps and goes crashing through your complex, that's a big claim, and that's a wind claim. So what are the other structures that aren't just your property, that are around your property to kind of look at?
Yeah, properties that are close to the coast are going to have coastal insurance that comes with it. That's going to probably be about 1 to 1.5% higher than a normal insurance coverage would be. Things that I also want to maybe know about too, and James has talked a little bit about things that consumers should be observant on. That what comes to my mind is like Federal Pacific panels. You know, these are panels that are like circuit breakers on apartment units. So when the electricity comes in, it goes to the circuit breaker, and that circuit breaker was built in the 70s or 80s, and Federal Pacific actually went bankrupt. But a lot of these properties that are B and C have these Federal Pacific panels on it. Do your carriers or your markets have any issues with the Federal Pacific panels at all?
They don't ask about the panel, but they do ask about the type of wiring. And so you will get questions about, is it aluminum? Which 70s, 80s, Federal Pacific, high probability, yes. Is it copper? Is part of it aluminum? And then they've done copper to go into the panel, you know, to kind of...
So that's my second question,
Yeah.
really, is the wiring on the property aluminum or copper? And if it is aluminum, which was the way that a lot of properties were built in the 20s, 30s, 40s, and 50s when copper wasn't really available. But has the property been pigtailed or collared into the boxes or into the electrical circuits itself? So that's a good question to ask, is how do insurance companies review the aluminum versus copper? Third thing is flat roofs. Any issues with flat roofs with insurance carriers?
Yeah, so about the wiring, insurance underwriters hate aluminum. You're never going to get a favorable rate out of aluminum, but they do need to know if it's knob and tube or how it's pigtailed. And if there's been some copper amendment, is it part aluminum, part copper? So yeah, that definitely affects your rates 100%, and sometimes affects what carriers will take that risk. Right. But going into the roofs, there's all different types of roofs, and the roof question, not only the update of the roof, but what type of roof it is a question that's on most insurance applications and questionnaires. Are we dealing with a flat roof? And in flat roofs, we can have TPO, which if you're doing apartments, you might run into.
What's a TPO?
So TPO is kind of a rollout membrane of a roof.
Rubber membrane.
Mm-hmm.
Okay.
And if you pierce the membrane, it's pooched, So you're going to have a problem if any part of the membrane gets pierced by hail or by debris or by a bad contractor messing around on top of your roof. So there's also a lot of pooling issues with flat roofs. Google Earth is so cool. Insurance agents, I think, and if they don't, they should use Google Earth all the time, because you can get right down and you can see based on a date what the water pooling is on a roof. So you can see your low spots.
So what you'll see is a flat roof typically is going to be white, and then the pooling is going to be gray.
Yeah, darker. There'll be a definite light contrast there. Sometimes you see the pooling around your AC units, which of course you never want to see. But you don't want to see pooling anywhere, because that's just indicative of subfloor issues or of piercing issues. And if you don't think that the underwriters are using Google Earth, you're mistaken, because they are. So they don't just trust blindly what the insurance carriers or the insurance agencies put down there. Nobody trusts anybody. Everybody sends inspectors, or they look themselves when they're doing the quote. And of course, all your quotes are subject to inspection. So be honest, be upfront, because they're going to be checking you. But yeah, those flat roofs aren't as good as a pitched roof. You definitely want to see a pitch, a gable, a hip roof. Mansards aren't that popular, because mansard roofs, which you see on a lot of apartment complexes, B and C class here in the North Dallas area, take a lot of damage from straight line winds, which we get a lot of. They take a lot of hail damage. It's a lot of repair on those mansard roofs. The type of shingle is very important. So it's not just when the roof was updated or replaced. How was it updated and replaced, and what type of roof is it?
And the other thing I want to talk a little bit about is flood insurance. I mean, we touched upon it real briefly on flood insurance. It really is it's a separate policy that's done for insurance. It's usually covered by the National Flood Insurance or Lloyd's or somebody else. It's usually not inside a policy itself. So we have a lot of properties, not a lot of properties, but a few properties every now and then that are requiring a flood insurance. And so Kim and her group are going to do a flood assessment. They're going to take it to a group that's going to eyeball it and kind of figure out by the survey whether the property is in a flood zone or not. And they'll compare that to the national flood maps to kind of determine what that looks like. Now, that property may be an inch in the flood zone, or it could be 10 feet in the flood zone. And if it's an inch in, you're going to pay a price, and if it's by 10 feet, you may have to pay a larger price. Mm-hmm. So if you're trying to figure out if it's deep in a flood zone, you think it's either not in a flood zone or it's not that much into a flood zone, you can have a surveyor go out and look at the property and then do an assessment by the amount that the property's in a flood zone. And they'll do what's called a LOMA letter based on the surveyor's depth of how deep that property is in a flood zone, and they'll charge you a different price if it's greater or lower in a flood zone itself. So that may be something that you may want to consider to have done if you find a property that's in a flood zone, by having a surveyor do the analysis to figure out how deep it's in a flood zone.
So here's a couple of things about flood, and I'm writing some flood in Central Texas and on the coast right now. There's a couple of different places to get your flood insurance. A lot of people think that NFIP, which is here in Texas, is the only market for flood insurance, and it may be the only market available to you if you've had a lot of claims with one of the other markets. But Philadelphia writes multifamily flood, Assurant writes multifamily flood, and WKFC writes multifamily flood. So there are a few options, but in addition to the flood zone mapping, which during the quoting process, the address lets you know if you're flood zone mapping, flood looks at not only the flood zone, and there's tons of flood zones, but they also look at elevation. So, what Paul was referring to when you need a surveyor is to get the elevation. Usually your price doesn't change if you're at 0 elevation up to 4 inches, but the second you hit -1 on your flood elevation, man, you see a big increase. I mean, it's a real increase. And so that surveyor elevation certificate is very important. Flood is also written per building.
That's correct. And that's an important distinction because I've had properties that we have financed where we had 29 buildings total, and 27 of them were in a flood zone.
Yeah.
So per building, it becomes a very expensive transaction to do.
Yeah, but they don't write blanket flood.
Nope.
That's not an option for people, at least not in the state of Texas. So you could luck out and only have 1 or 2 buildings at that -1 elevation in a high priority flood zone, or you may, have a lot of buildings in the flood zone. And so, getting that quoted and getting that figured out up front in your due diligence really lets you know where your premium is going to be. Because as an example, this place I'm quoting in Central Texas, per building, these little 8-unit buildings that they had, and they have 23 of them, it's $700 for flood per building if it's above the 0 elevation mark. But it jumps to $2,900
per
building as soon as you hit that -1 elevation mark. And that's intense.
So is that below sea level? What's that when you say -1 elevation? What does that mean?
I'm not a surveyor.
Below? Okay, all right. So, but you can see it on a survey. It'll say
the elevation. Okay. It'll give you. I don't know if that's inches because what they look at, what NFIP looks at, is -1, 0, 1, 2, 3, 4, and so those are the elevation numbers that they look at. And so, what constitutes a 0, a -1, and a 1, the differences between them, I don't know if those are inches or feet. I don't know what metric they use for that. I should probably figure that out. I just don't know, but it wouldn't matter.
Okay. So get a survey or get an updated survey.
Definitely get a survey.
Early on in the process,
yes.
Especially if it's been an older one, older property.
Yeah.
So we can figure out some of that. Okay.
Yeah.
And then I know we've talked a lot about sort of at the acquisition phase, but a lot of our listeners are owners already. And so when is a good time to look at their insurance coverages? And then, is it only during the renewals? Should they give you a call and figure out what new options are out there in terms of coverages? When do you hear from owners a lot of times?
So in the acquisition process, you can't start your insurance too early. I say that because the insurance could be a make it or a break it deal for you on a property because it's definitely a fixed expense. Going back to DUS lenders, they require the insurance certificates 3 weeks prior to close. Right. And a lot of people don't realize that. They save their insurance kind of till the end, and then they're upset when their closing gets pushed off. But the DUS lenders like to have everything on insurance reviewed and in file 3 weeks prior to the close date. And so you don't want to miss a close date because you don't have that.
Very good.
Because you don't have that together. Not all lenders require that, but DUS certainly does. So get your insurance done right up front. Get the information over to them, and then you won't have to mess with the insurance people too much, but you'll have that piece to the puzzle finished. Multifamily insurance is considered commercial, and commercial insurance has a birth date. And so it's typically the same date every year, just like a regular birth date is. The only time you would change that is if you are refining. The only time you would look at insurance prior to its birth date is if you're going to refi the property or if you're firing the insurance. For whatever reason, you're firing the carrier, you're firing your agent, you've got a real good reason for wanting to switch insurance midstream because, of course, there's minimum earned premiums. And sometimes...
What does that mean?
So a minimum earned premium, the insurance carrier wants to get paid. They don't want you switching your insurance every month. It's not like your home insurance and your auto insurance that you can switch nilly-willy without fear of penalty, which you can do with your home and auto insurance. You can move it around all you want, shop for a better deal. Because there's so much involved with commercial insurance, because it's such a lengthy process to get done, it's a lot of work that you put all those people through. And so they put minimum earned premiums, usually 25% or even 50%. Sometimes they're what's called accelerated wind hail premiums and deductibles if you're in a wind hail zone. That's the minimum amount of money that you are losing on a deal, whether you want to switch it or not. So if you have a $10,000 deal, that's your insurance premium, and it's 25% minimum earned, that means $2,500 is sunk. Whether you cancel that insurance 20 days later or 3 months later or not, you will not be refunded that amount. It's fixed, it's minimum earned. So
is that usually about a year in premium, or it's less?
No,
It seems
your
like
insurance is every year.
Your insurance is every year,
Yeah.
but I'm saying that minimum earned premium
It's just part of the policy.
It's part of the policy, but it's typically lower than 100%, I'm assuming. So if you stay with a insurance carrier for a year, then you shouldn't have that issue. Is that what you're saying? It shouldn't be an issue. Okay.
But when you renew
Right.
your policy,
When you renew, right.
it's going to probably be 25% minimum earned or 50% minimum earned also. And so that's because usually if you approach the whole marketplace, if your agent or your broker does a good job for you and goes to the entire marketplace and gets you multiple quotes, multiple options, you should probably have the best option for you when you're purchasing your policy. And so there's really no point in switching it midstream unless something crazy happens. And of course, that always does happen. I usually tell my clients not to shop their insurance more than about every 2 years or 3 years because the appetite usually doesn't change. If there is a change in appetite, your agent should know that and can kind of guide you in that direction so you can know to shop your insurance. But carriers won't typically look 90 days prior to a renewal. And so there's really no point in even approaching a carrier before 90 days of your renewal date, your birth date for your policy, because the quotes won't be valid. Too much happens. Too many weather events happen. Too many claims can happen. And like I said, they look at loss histories, up to the minute, up to date. They want 90-day currently valued loss histories. And that's because typically only quote you ahead of time 90 days.
90
there's a
days.
correlation
Okay.
there. So 3 months prior to your insurance renewing, if you're thinking about renewing it or shopping it or finding a different agent or broker, that's a good time to do it. Definitely, again, don't leave it till the last minute because it takes those guys time. 30 days is a hard timeline. 30 days is a really hard timeline to get indications back from people and to gather all the necessary information. So between 90 days and 30 days, you should be shopping it if you're going to.
Okay. And then I guess if there was big changes on the property, that would be the only time you maybe would change after a year. Let's say
Yeah.
you're doing a heavy rehab, and so you're updating a lot of those systems. And now, would your insurance drop at that point once you've done all of that rehab and then you go back and shop it again? Is that fair? Is that a fair way of looking at it?
It could definitely. You might get maybe not a discount on your current premium, but you may qualify or be more attractive for the appetite of a different carrier,
Okay.
which might give you something better if you've made some of these updates. If you make some updates and you can move your policy from actual cash value to replacement cost, that's huge for you as an owner. If you're adding or deleting units, that's a huge change on your policy. If you're upgrading the exteriors, that's a huge change on your policy. So for those reasons, you might want to shop your insurance or at least call your current insurance and make an update to it like, hey, we don't have 100 units anymore. We have 105 units now.
Okay.
They have to know that.
Right.
They've also got to know if you've added a new laundry facility. If you've added a new electrical facility, a workout room, things that we find a lot when we quote insurance. And I like to go to a property and walk it during due diligence with my clients if I can physically get there. Offering memorandums oftentimes don't include all the buildings,
Right.
which is wild. Current insurances often don't include all the buildings, which I think is wild. Sometimes even from Google Earth, trees can obscure your laundry room. They can obscure your boiler room, your electric room. They could obscure your chillers. You might not see the maintenance hutch on a particular building. And so you definitely want to physically see your property. And if your insurance agent can get there, awesome. Because there's a lot of things that pop up that you wouldn't know otherwise, because how would you know to make sure? You think there's 23 rentable units, so there's 23 rentable buildings, so that's all you need insurance for. But if there's a separate laundry maintenance issue, where are you going to have a fire? Probably in the laundry maintenance,
right.
And then you have to replace all your laundry machines. Well, that's a big claim, and you definitely want insurance coverage for that. So you want to make sure that that building is on your policy, even though it's not a habitational building. We need to look at every structure: pools, playgrounds, tennis courts, chillers, boiler, maintenance rooms, laundry rooms, huge sheds where equipment is kept, separate leasing offices, separate workout areas. Those are all things you want on your policy. So you need to make sure that your property policy includes all of those coverages.
Okay. Anything else as we wrap up here? Anything else that we haven't covered that you would like our listeners to know about? Or you can just share a little bit about sort of how people can reach out to you if they are looking at an acquisition of a commercial property or looking at a renewal.
I think the insurance is one of those things you really need to be educated on. Educate yourself on insurance to make sure that you can ask the right questions of your broker or your agent to make sure that they are going to comprehensively look at your risk and have your strategy in mind, because everybody's strategy is very different. That's something that we do. Is I want to know what your strategy is going into a property so I can help you mitigate the risks and still be in line with your strategy. Empower yourself. I like to tell people, empower yourself when it comes to insurance, because it can make or break a deal for you. And so you want to make sure that you're asking the right questions of your agent to make sure that they're knowledgeable enough to get you what you really need. Just a couple of key questions will really trigger up the ears of the insurance broker or agent that you're talking to. Anything that we've talked about today will kind of put them on their toes. Getting in touch with us is easy. I like to talk to people on my cell phone. I work by text, I work by email, I work by cell. I don't know if you're going to post those numbers or if I should tell people those numbers.
Tell them.
So my name is Kim Stallings, and my cell phone is 940-367-9740. My email is Kim, Kim, at heritageriskadvisors.com. I love to answer questions. I love to educate. Feel free. Reach out to me no matter what state you're in, where you are, with any questions or concerns you might have, because knowledge is power. And like I said, part of our mission statement is to demystify insurance.
And can you write insurance in other states?
Most definitely. We follow our investors around state to state. When you find a good agent, you want to take them with you. So that's just a reciprocal license. We write in Texas, of course, Mississippi, Louisiana, Oklahoma, Florida. We're out in California. We move around. It's really easy to get a reciprocal license for insurance. So
great. Well, some great knowledge, Kim. We do appreciate you coming in. I mean, Kim's point is a very valid point. I mean, they are risk advisors that help you mitigate the risk. So, we all want to try to get that risk down as low as possible and make prudent decisions with lower risk. Anything more to add to it, James?
No, that's it. I mean, thank you very much, Kim, for coming in, and look forward to working with you in the future.
Yeah, my pleasure, guys.
Thanks.
Thanks.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview. Thank you for listening to the Old Capital